another thing, January Barometer. The January Barometer is something else that Yo Hirsch brought about. The January Barometer from January 1st to January 31st, it gives you the positivity return or the negative return on the S&P 500 during the first month of January, right? What's significant about that is people argue, and according to the January Barometer, you say if the market was positive during that time frame, then for the remainder of the year, the market is going to yield a positive return. Conversely, if the market was negative during January 1st to January 31st, the market is going to bring forth a negative annual return, right? People literally use the month of January to determine whether they're going to invest into the stock market or not, right? So with the January Barometer, let's see, because I had a note or two, right? Some people argue, is it really accurate? And what we mean by that is, for one, we only use the January Barometer in the in the country, in the U.S., the January Barometer is only used. In other words, it's not used in other markets, such as Japan, such as China, such as Europe, right? These markets trade the yen. These markets, you have the DAX and other stock market exchanges throughout the world. So therefore, we're not lining the January Barometer up against those other countries, right? It's only a U.S. thing, so to speak. In addition, some people sit back and say, wait a minute, I'm not the sharpest knife in the drawer. However, if the market does yield a positive return during the month of January, and people know what the January Barometer is, people are thus going to invest more into the market throughout the year based off of the notion that the market rose during January. So, in other words, is it the January Barometer that's more so accurate, or is it the fact that people are basically self-reinforcing the market to rise due to the January Barometer being positive, right? Think about that. If I'm sitting back waiting for February to come to invest into the market based off of its positivity, then is it really the January Barometer that's accurate, or is it that the market has risen in January and now I'm sitting back saying, I know the market is going to be positive for the remainder of the year, so thus I'm going to now invest into the stock market for the remainder of the year due to me knowing it's being positive? That's a good argument, right? So, I digress. So let me say this. The January Barometer may have a self-reinforcing character. If U.S. investors react to a strong January by investing more heavily in stocks, then this itself might cause prices to rise. That's pretty much what I just told you all. A real-world example of the January Barometer. In recent years, the January Barometer has had mixed results. This is a little backlash, right? In 2022, the S&P 500 declined by more than 5% in January and ended in a 20% loss. In 2021, the S&P 500 declined by 1.1% in January, but went on to gain just under 27% on the year. The results in 2020 were more ambiguous, right? What does ambiguous mean? Ambiguous basically means, basically having more than one interpretation, right? There's no clear indication on what's being said. You could interpret it in multiple ways depending on the way in which you look at the situation and or subject. The results in 2020 were more ambiguous, with the S&P 500 losing 0.16% in January, only to go on to a 16% rally. So that's basically contradictory opposed to what the January Barometer usually represents, right? Because if you lost 0.16%, then how in the month of January, then how can you possibly gain 16% throughout the year? It doesn't make sense, and it's counterintuitive of the definition of the January Barometer itself, right? Because if you lost in the month, how could you gain during the year? The two doesn't make sense. But again, this is not accurate. This is pretty much seasonal patterns that takes place, and we predict it from year to year. So keep that in mind as well. Okay, in 2019, the S&P 500 climbed by 7.87% in January and finished the year up 28.9%. So you could argue that it's accurate. You could argue that it's not, because it did increase by 7.87%, but it went on to a 28.9%. So why was the percentage so different, right? But if you invested, you would have yielded a much higher positive return. So therefore, in my opinion, you should be happy about the positive return, opposed to a negative return taking place and you'll be mad altogether, right? So I did a little math for you all myself, and I said this year, January 2nd, 2024 was the first trading day of the year. The S&P 500 traded that particular day at 4,742, right? Fast forward to today, well, yesterday, Friday, December 13th, the S&P 500, let me rewind. January 2nd, the S&P 500 closed at 4,742. January 31st, the S&P 500 closed at 4,845. What's significant about that? If you've been paying attention, you would know that the January Barometer has indicated a positive return for that month. Reason being that the S&P 500 itself rose from 4,742 to 4,845. What's significant about that? What's significant about that is the S&P 500 should yield a positive return based off of the definition itself of the January Barometer. Has the S&P 500 did that? Let's see. We said the year it started off 4,742. Now the S&P 500 currently trades at, 6,051. So yes, according to the January Barometer in 2024, we're looking to prove its accuracy. I digress. Listen, thank you for watching this video. Thank you for staying tuned. These indicators are significant because they can make you a better trader, right? If you want to look for pockets to get into the market, if you're looking to determine what takes place, what is taking place, what direction the market is potentially headed in, you could use these indicators to guide you along the way. However, if you have a 401k or any sort of retirement plan, just continue to meet your contributions and make sure that you're maxing out the employer contribution, right? You want to max out up until that amount that the employer is contributing to your 401k or whatever retirement account that you have. In addition, if you're dollar cost averaging, stick to the same formula, beloved. I know that was a lot of information. I know that you got to run it back. But if you're dollar cost averaging, don't get caught up into the hype. Dollar cost averaging is you not timing the market and just throwing money in the market repeatedly, no matter if it's all the way up in my Fat Joe voice or all the way down. Shout out to Remy and Pat Poose. If you dollar cost average, over the course of time, you're going to beat the market. I guarantee you. Because you're not sitting back waiting, right? If you know what the market is going to do, then you would arguably be the best investor